There's a lot of volatility, a lot of panic, and markets are in a frenzy. What should the average investor understand about this environment and what should they be doing? Hi, my name is Sid Misra and I'm a certified financial planner who is passionate about financial education. I believe that the more you understand the financial system, the more you can use it to your advantage. And that goes for those just starting out in their financial journey, those who have been traveling for some time, and those who are nearing retirement. So according to LPL Research, and that's the research arm of our broker-dealer LPL Financial, the last 6 weeks, the S&P 500 index, which tracks the largest 500 companies in US stock exchanges, that index has finished lower in the last 6 weeks, every week for the last 6 weeks. Things are not looking good for the market, things are not looking great for investors, but what can they learn about the environment that they're in right now? And what can they do to help themselves? Let's start with the question, what can they learn about this type of environment? Now, I'm not going to talk about the reasons why there's volatility, the reasons why the market has had a pullback. Those are different reasons that you can research about or you can read about, and things will change over time as new information comes out. But what I want to talk about is volatility itself and market returns throughout the year and what the year ends at. And that's what this slide here is showing. So this is a slide from JP Morgan's Guide to the Markets. It's a guide and presentation that they have. I will link to that in the description below. And what this guide is showing is S&P 500 returns from 1980 until 2022. Now, the red dot that you see, the negative number that you see there, shows that during a given year, that is the lowest point the S&P hit for that year, and the gray number that you see above that is what the S&P actually finished at the year end. So if we take a look at 1980, which is all the way to the left in this slide, we can see that during the year of 1980, there was a point in time where the S&P 500 was down 17%. But in that same year, the S&P 500 finished the year at plus 26, right? It had a 26% return. 1987 is another example we can use where we see that the S&P at whatever point during that year was down 34%, but above that there's a 2% number with that gray bar, and again that's showing us what the S&P ended at. And even though it was down 34% at some time in 1987, it actually finished up for the year. It finished up 2%. This is important to understand if you're an investor, right? Down markets are a part of every market cycle. There's always going to be volatility, whether it's week to week, month to month, sometimes within the year, right? We see that especially with this slide here. But what's important to note is that even though the S&P, the markets may be down during the year, that doesn't necessarily mean that they won't finish up later on. And they won't finish up to close out the year. In fact, if we look at this slide from JP Morgan, out of the 42 years that are shown in this slide, 32 of those years finished positive. That's 76% of the time, even with down markets, even with times during those specific years, the S&P was down big. 1987, for example, like we went over, down 34%, but still finished positive 2% for the year. So that is a little bit of background info on the volatility side of it. That's something that I wanted to share with you. It's a very interesting slide that I thought would add some value. The next one I want to go over is what investors should be doing with this information, right? We know that markets have pullbacks. We know that during the year there may be a down point, and with that previous slide, it may end up for the year, right? There are good chances of that happening as we saw in that previous slide. But what should investors be doing? Now, what we normally see in times of market volatility, times of panic, times of just, downturns in the market is people panic. They start letting emotions dictate their actions. And what we often see is people getting out of the market and putting their money in cash, keeping it on the sideline. Because for them, they're waiting for, less volatility. They're waiting for a calmer time to re-enter the market. Now, timing the market is something that people think that they can do, They think that they can figure out a way to do that, but in reality, timing the market is very, very difficult. You may get lucky a few times, but it's not something that you can consistently do over a long period of time and be successful at as well. So this specific slide that I'm showing you from JP Morgan again, which is from their guide to retirement. Again, I will link to this slide and this guide in the description below. This is showing us the impact of being out of the market. So if you're those people that panics and gets out of the market, you're really going to want to pay attention to this slide. Now, what this is showing is market returns, the S&P 500 return from 2001, January 1st until December 31st, 2021. And if we look all the way to the left, if you were invested during this entire time, you would have had about a 9.5% return. That's what the S&P 500 did over this time period. Now, to the left of that in this bar chart, it shows you that if you miss the 10 best days investing in the market because you panicked, you pulled money out, you kept it on the sideline, your return is almost cut in half. It goes from 9.5% down to 5.33%. That's almost being cut in half by only missing the 10 best days. What happens if you miss the 30 best days? Now your return is less than 1%. And if you miss the 40 best days or beyond, 50 or 60, now you're talking about negative return territory where you've lost money because you're trying to time the market and get it in and out based on whatever information that you may have. And so again, this is an important slide to understand that staying invested gives you the best chance of getting all of those market returns, and timing the market is something that you're not going to be able to do successfully. Now, when we talk about the 10 best days in this example, I want you to note this. We can only figure that out after the fact. We only know that in hindsight. So when the dust settles, we can look back and see with our charts and our information that these were the 10 best days, these were the 20 best days, the 30 best days. But while we're in it, while it's happening to us right now, and I'm recording this on May 17th, 2022, market is very volatile. We don't know what the top is. We don't know what the bottom is. We don't know what it's going to do tomorrow or a week from now or a month from now. So trying to guess when to get in, when to get out, how to avoid missing out on the 10 best days, it's going to be very difficult. Your best bet is to stay the course and stay invested. So what can the average investor do to be successful? Well, like I mentioned, staying the course is going to be an important thing. If you have an investment plan, sticking to that is going to be one of the best things that you can do for yourself. Now, an investment plan has laid out the goals that you're trying to accomplish, the time frame that you want to accomplish them in, the risk level that you're willing to take on to get to that point, right? And from there, you start developing the portfolio and figuring out the investments. You don't go backwards, which is what most people do, where they think about the investments first. You need to figure out your goals, your plan, and your portfolio. So having an investment plan is going to be key to your success. Now, if you don't have a plan, this is the best time right now. This is the time to sit down and get very, very clear on what you want to accomplish and get very clear on how you're going to accomplish that. But if you don't have a plan, you're going to be listening to the market news, you're going to be listening to the pundits on TV, and you're most likely going to panic and make a mistake. Now, if you don't have a plan, you can make one yourself. These are things that you could, Google and figure out how to do that. But I also recommend that if you don't want to do that, you don't want to spend the time doing that, find an investment professional, someone that you can trust to help build a plan for you, and that will also guide you along the way. Things change, your goals may change, and so we want to make sure that this is constantly monitored and you're agile and nimble enough to make the changes that are needed. But you need to make a plan and you need to have all of this in writing so that you know what you're trying to do and how you're trying to do it. So again, market volatility happens. There are points in time during the year where the market may be down and may be in negative territory, but it could end up for the year. We've seen that with the first slide I showed from JP Morgan's Guide to the Markets. And with that information and understanding, we know with the second slide, JP Morgan's Guide to Retirement slide that shows the impact of being out of the markets, What happens when we panic and we make those mistakes? We miss out on good investing days and we really hurt ourselves and our rate of return that we could be getting over a long period of time. So make a plan, build that out, make sure you understand what you're trying to accomplish, your time frame, the risk level that you want to bring on, and then build a portfolio that's going to complement that. If you don't have a plan, you need to build one, or you need to find someone that can do it for you and help guide you. Now, I hope this video was valuable. I hope you found it educational. If you did, please give it a like. It helps YouTube's algorithm push this to other people that may find it valuable and educational as well. And please subscribe so you don't miss out on any future videos. Thank you so much for your support. I really appreciate it, and I look forward to seeing you soon. Take care.